Balance sheet, income statement, and comprehensive income. Under the US GAAP, your general purpose financial statement is defined as a full set of financial statements and, of course, the notes to the financial statement. There are 5 components. A full set of financial statements typically include 5 components, namely statement of financial position, also called balance sheet, statement of earnings, called income statement, statement of comprehensive income, statement of cash flows, and statement of owner's equity. We are going to discuss each one of them in sufficient detail so as to cover everything and give you the complete syllabus coverage. So first, let's have a look at a balance sheet, how it is structured and what are the components, and then we'll discuss as we proceed. Assets are segregated into current and non-current. Within current assets, you have cash and cash equivalents, trading securities. At fair value, we'll discuss account receivables, net of allowances, note receivables, inventory, and prepayments. And in investment classification, we have available sales securities, held to maturity, investment in affiliates. And then in the long-lived assets, also called the property, plant, and equipment, or the fixed assets, we have land, building, equipment, goodwill, and patent, that is intangible, and other assets, that is pension and other post-retirement benefits, deferred income. We are going to discuss each one of them in detail in the coming sessions. And in the current liabilities, we have the liabilities which need to be settled within 1 year or operating cycle, whichever is longer. And long-term liabilities include bonds, deferred tax liabilities, pension obligations, and then we have stockholders' equity consisting of preferred and common stock and some other components of equity. Everything is coming in the subsequent classes. Income statement. What is the purpose of the income statement? I have structured my slides not showing you the points, rather questions. It is easier to remember what is asked and what is answered rather than just the bullet points. So this structuring would help you absorb the idea, remember points from viewpoints of questions, not just text for the sake of text or just bullet points for the sake of bullet points. It says, what is the purpose of income statement? You need to know. The income statement details how funds are used and generated in a business. It will show you expenses, losses, revenues, gains, which we will discuss in the next slide. What can the income statement tell us about a company? An income statement shows you the profitability of a business. It shows you operational efficiency and how it manages earnings and how it manages its expenses. Then it says, how is the income statement useful for future financial predictions? Yes, this is a very important question. It provides historical data that is essential for future forecasting, future cash flows, and of course, evaluating companies' financial stability. Various components of income statement. In the income statement, you will see costs, unexpired costs, revenues, expenses, gains, and losses. Let us discuss them briefly. What are costs and unexpired costs? Costs are amounts we have spent on items like acquiring assets, acquiring services. And what is an expired cost? The cost that is not yet used or the benefit of which has not yet been utilized. Consider you have paid insurance premium covering the current period 6 months. Maybe you paid on 1st of July up to next year 30th of June. So 6 months for the current period would be the cost for the current period, and the next 6 months payment which have been made in advance is unexpired cost. That is what you call the prepaid insurance or the insurance paid in advance. What are revenues? Revenues are the total money earned from goods or services, and of course these are just the earnings. We haven't yet deducted any expenses from them. What are expenses? I guess a key difference that you need to remember, revenues are central and ongoing. Some goods or services that you keep on selling as a part of your regular operation. And expenses are the costs incurred in the current period to generate revenues. So these are again recursive and repetitive. Revenues and expenses are central for ongoing business operations. Gains are incomes, but they are not central or ongoing. So there is a clear difference you need to remember between gain and revenue and expenses and losses. Revenues and expenses are central and ongoing, whereas gains and losses are not central, rather they are incidental. For example, any gain on disposal of old asset, any commission income earned, whereas our main business might be trading, so you may have earned some commission on transaction, right? So certain gains and losses which are not central to our business activity. So what are gains? Gains are profits from the transaction not in the ordinary course of business, like selling a fixed asset for more than its book value. What are losses? Clearly, losses are the amount lost, such as from selling investments below their book value or losing assets without generating revenue. And these two are not central. They are just incidental, peripheral transactions. They have little occurrence, but revenues and expenses are central and ongoing, and they keep on repeating every period. Then we have multi-step and single-step income statement. Let's see. This is it. This is your multi-step income statement where you have sales, that's cost of sales, and this gives you gross profit. Then you deduct your selling and administrative expenses, you get your operating profit. Then you consider your revenues and gains, this gives you, and then you deduct your interest expense, any loss on sale of fixed assets, any restructuring expenses. This gives you income before taxes. Then you deduct tax, you get income from continuing operation, and then you have discontinued operation. We'll discuss this in the coming slides. So this is what you call the multi-step income statement, where you have different layers of profitability: gross profit, profit from operations, profit before tax, and finally the profit after tax. So this is called a multi-step income statement. So in a single step income statement, we make a shortcut. What we do, we add all our revenues, whether they are central or maybe just coincidental or peripheral, all revenues, sales revenue, service revenue, interest revenue, rental revenue, gain from sale of securities, gain on disposal, and other revenues, all revenues in one direction, in one place, and deduct all the expenses to get you a single figure for expenses. And this gives you the income from continuing operation. Then discontinued operations we'll discuss just a little while, and then you get the same net income as we got previously. So it's just a one-step arrangement where you have all the expenses and all revenues in one place to give you the net figure for the profit. Clearly, it's not a good option, not a good presentation, because as a manager, I would like to see my different levels of profitability: my operating profit, my gross profit, my trading profit, my profit from other activities, then income before taxes, and then of course net income. So this is not a very useful format. So what does a multi-step income statement report? It reports your operating revenue, your operating expenses, and they are shown separately from non-operating expenses or non-operating items. Then what is the benefit of multi-step income statement? I just told you it provides detailed data useful for calculating various levels of profitability, for calculating various analytical ratios. We will discuss this ratio analysis as well in the coming classes. What does a single step income statement include? Well, it combines all revenues in one place and expenses on the other, including income taxes, of course, and it does it in a single calculation. So what are the benefits of single step income statement? I would say only simplicity. It just offers a simple design and treats all types of revenues and expenses equally important. So that is just the only benefit of single step. Then we have a very important topic on discussion: discontinued operation. MServ Incorporated is a food service company that delivers frozen food products to food service providers. Its clients include fast food restaurants, high-end steak houses, home delivery diet food companies, and institutions such as schools and hospitals. Historically, the fast food restaurants have been the largest segment of MServ's business in terms of revenues and operating profit. However, that division is now forecast to begin to decline in revenues because the public is looking for healthier options. MServ has decided to sell its fast food operation and instead focus on selling to locally operated restaurants offering a healthier fare. Such restaurants will generally show lower revenue per unit but higher operating profit per unit. So because the fast food division is the largest component in terms of revenue and operating profit, the disposal represents a major strategic shift and will be reported as a discontinued operation. So this is what a discontinued operation is. So you think a certain segment is not performing well, you just simply close it down. Let's discuss something about discontinued operations in details. So what are discontinued operations in an income statement? We just saw discontinued operations are reported separately from continuing operations. Let me show you. Net of tax, and they may include any component or group of business that are going to be killed, that will not continue in the future. Let me show you. They are reported separately from income from continuing operation. Of course, this is after the net income, so you need to net income from continuing operations. So you need to report it on net of tax basis. This is an important point to be remembered. Then what may discontinued operations consist of? Well, they can consist of just like a division, maybe impairment losses, or maybe gains or losses from actual operations and gains or losses on disposal. We'll discuss this with numbers as we proceed. And then it says, when are operations classified as discontinued? That's an interesting question. Normally, operations are classified as discontinued when a component or a group of component has been disposed, or maybe they are held for sale. Either they have been disposed or they are held for sale. Then it says what conditions must be present for operations to be reported in discontinued operations. Yes, there are certain conditions to be met. So for this, operations that you're discontinuing, you're leaving off, they must represent a strategic shift that will significantly affect your business operations, and it will significantly affect your financial results, right? So it could be a major business line or a major geographic area. So this discontinuance will have a significant effect on your financial results. It will have a significant effect on your strategy. It's a major strategic shift. So these are a couple of conditions to be present. What triggers the reporting of cost in discontinued operation? Costs are recognized when obligations to others exist. When we discontinue a segment, it may involve laying off some staff. Some people will have to be made redundant. So when you lay them off, you need to pay them something. So let us assume that we are going to lay off a few staff members because of this discontinued segment, and it might require employee severance pay. You need to pay them legally because they have been dismissed. 50,000, and then there's some contract termination fee, just for short, contract termination fee, $30,000. So this 80,000, these obligations in total 80,000 need to be recognized immediately as costs related to discontinuation. So this is the cost we were talking about. This cost needs to be recognized. This total cost relating to discontinuation of the business needs to be recognized in your financial statement when we decide to discontinue a segment. Further on discontinued operations, some computations. What types of items are included in the results of discontinued operation? Well, the results include operations of the component, any gain or loss on disposal of that component, or impairment losses with any subsequent changes in the fair value. We'll discuss as we proceed. It says, how are the initial and subsequent impairment losses treated? Alright, let's take an example. Let us suppose a company decides to discontinue its electronic division due to some strategic realignment. So we have some financial details to make this decision. We have the carrying value of the division, or the carrying amount. I will simply write CV, carrying amount of the division, that is about let's say $1 million, and the fair value less any cost to sell initially. Fair value minus any cost to sell is, let's say, $800,000, right? So then there are three types of items to be reported. First, it might have continued operating 1st of January 2025 to maybe 30th of June 2025, let's say. So the result of these 6 months. So this needs to, this operating result, normal operating result of this electronic division up to the point of disposal. This is the first part, result of operations. Second, the gain or loss on disposal. When you will sell these assets, so either there is going to be a gain or a loss on disposal. Let us assume that we dispose of this segment for $750,000. So the carrying value was 1 million. We are disposing it off at 750. So this clearly shows that there is a loss. And the third component we will discuss in detail further, the impairment loss and any subsequent fair value adjustments. Given the initial fair value is less than the carrying amount. What was our initial fair value? Less cost to sell, it was $800,000. So let us suppose that after a few months, the fair value of the division increases to 850. This is the point we are discussing. What happens with subsequent increase in fair value? So if the fair value increases to 850 due to improved market conditions, what would we do? Since there was an initial loss of $200,000 and the fair value has now increased by $50,000. So what this will do, this 50,000 gain, 800 versus 850, this 50,000 gain will partially offset the impairment loss. Next question says, when are results reported for discontinued operations? Well, results are reported in discontinued operations during the period the component is either disposed of, you kill it off, or you decide to classify it as held for sale. I'll discuss it as we proceed. Then it says, how do we treat depreciation and amortization after discontinued operation? Please note, once a decision is made to dispose of a component, it is no longer depreciated, it is no longer amortized. For example, if a building part is being discontinued and it was previously depreciated for, let's say, $20,000, this depreciation stops once you have decided to dispose of this segment. Then it says, how is a component classified as held for sale measured? Let us discuss this. This is a bit technical. Okay, let's say we have a component we want to sell. So, and we have decided it to, for timing, to keep it as held for sale, let's say. So a component that is held for sale is measured at either its carrying amount or fair value minus cost to sell. Cost to sell. Cost to sell means cost needed to complete the sale. Right? So let's say the carrying amount is $300,000. Fair value, let's say, is $280, and cost to sell is 10. So that means it's $270. So 300 is the carrying amount, 270 is the fair value minus cost to sell. So the fair value clearly is minus cost to sell is lower than the carrying amount. So this is what we are going to use as the measurement value for this segment. Then it says, how should the result of a discontinued operation be presented in financial statements? Let me show you. This is it. This is it. The result of discontinued operations, net of tax, is reported as a separate component of income, and it has to be distinct from income from continuing operation. Then the question says, where should a gain or loss on disposal of a discontinued operation be disclosed? A gain or a loss on disposal should be disclosed either directly on the face of income statement I showed you, or in the notes to financial statements. Suppose in the previous example we were discussing, our carrying amount was 300,000, fair value minus cost to sell was 270, right? What happened? We sold it at 260. So this was the amount that we were reporting. Sale proceed 260. The difference, $10,000, is the loss on disposal. So this loss is shown separately on the income statement under the discontinued operation, or it may be reported in the notes to financial statement. We just discussed this a little while ago.